The bond and stock market had a somewhat robust positive reaction to the consumer price inflation report released yesterday. This was not justified, in my opinion. Possibly investors were reacting more to the better than expected major bank earnings that were released yesterday. The government reported that CPI rose 2.9% over the 12-month period ending in December 2024, the third consecutive monthly increase, and the month-to-month increase was 0.4%, which is at a 4.8% annualized rate. Core CPI, which excludes food and energy, was slightly better than the consensus estimates, but the annual rate, which is non-seasonally adjusted, fell only to 3.2% from 3.3% for the compared to the 3.3% 12-month increase for the 12 months ending in November 2024. So that's just a tenth of a point. The month-to-month increase in core CPI was 0.2%, down from 0.3% in the prior month, which is a positive, but month-to-month numbers will move up and down by a tenth of a point without establishing a longer-term trend. The month-to-month number in June 2024 was actually lower at 0.1, rising to 0.2 the next month and then increased to 0.3 in August, and stayed at that 0.3% increase through November and then fell to 0.2% in December. That does not establish a trend, in my opinion. What the CPI inflation data over the past several months indicates to me is that inflation is proving to be sticky near current levels, and that is without any major policy change that would result in inflationary pressures returning later this year and into 2026. There was a significant percentage move down in intermediate term treasury rates in response to this last CPI report, which makes the purchase of 2 to 8 year treasury notes slightly less appealing to me compared to upping my purchase of the 6-month treasury bill at next Monday's auction. You can find a table of the Treasury yield curve at the U.S. Treasury's website by simply Googling, quote, interest rate statistics, U.S. Department of Treasury, end quote. Using the data at that website, the 2-year Treasury note yield declined 10 basis points to 4.2% yesterday, putting the yield below the current 6-month Treasury bill investment rate. So I have to ask myself, is inflation dead? I don't think there is any reason to believe it is dead yet. Does the latest CPI report justify an opinion that inflation will return to a 2% annual rate this year? And I don't think it does. And the last question, maybe the most important one, is whether it is more probable that inflation will increase later this year and into 2026 rather than moving back to the Fed's 2% annual increase preferred level. All of these questions are relevant to whether I will continue buying intermediate term Treasury notes or simply wait until the yields are more favorable compared to the Treasury bills. My primary goal is capital preservation followed by income generation. While it is impossible to predict with any degree of certainty, and if you think you can, you may need to see a shrink, the future course of interest rates. The recent inflation data suggests to me that inflation is not dead and may soon present a major predicament for the Federal Reserve later this year if inflation turns back up. We have already seen the Fed make its second most serious monetary policy mistake in history that stoked inflationary pressures in 2021 by keeping the extremely abnormal monetary policies known as ZIRP, zero interest, and quantitative easing in place, as inflation moved into clearly problematic territory in 2021. Will they make the same mistake again by failing to raise rates when and if inflation starts to move meaningfully higher later this year? I'm not so sure they will respond in an appropriate way to a buildup in inflationary pressures, given how they responded to the last buildup. I may buy $10,000 of the treasury bill at next Monday's auction, that's January 20th, and hold off buying more treasury notes next week, particularly if the decline in intermediate term yields continues, which is how I will likely resolve the questions that I mentioned above in the video, at least for the moment. I have a lot of corporate bonds and treasury bills that mature every week. I had 30,000 in corporate bonds mature in one of my 4 brokerage accounts yesterday. So I have a continuing problem that's daily of how to reinvest the proceeds that I receive from maturing treasury bills and corporate bonds into a far lesser extent CDs. I discussed $6,000 in principal amount of treasury note purchases in my last weekly blog published yesterday, which leaves me with 5 more purchases to discuss in the next post. That may be it for at least a few weeks after I discuss those purchases. The investment rate for the 6-month Treasury bill rose to 4.33% at the January 13th auction from 4.256%. It doesn't sound like much, but that's a pretty big move up in a 6-month on a percentage basis in the 6-month Treasury bill. I would attribute the rise in the investment rate week over week as a response to the last positive jobs report, which indicates to me at least that no rate cut is needed now or likely to be needed within the next several months. Both the 3- and 6-month Treasury bills auctioned last Monday came in with the same investment rate of 4.33%, near the midpoint of the current federal funds range, which is 4.25 to 4.5%. Just as a snapshot in time, both of those investment rates signal a prediction made by investors that there will be no Fed rate cuts within the next 6 months. A 4.2% IRR for the 6-month Treasury bill would signal, in my opinion, a prediction of about even money for a 25 basis point cut in the federal funds rate no sooner than the June meeting. The bill would be coming due in July. I will be discussing Treasury bill purchases, Treasury note purchases, corporate bond purchases, and stock purchases in my blog, and the blog is published weekly.